You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Keith Schaefer, editor and publisher of the Oil and Gas Investments Bulletin, his website oilandgas-investments.com. Welcome to the first show of the new year.
Happy New Year, Jim.
Well, how happy has the year been for oil producers so far?
No, it's true. It's been a horrible year. The market has taken a tumble, and just when we thought that oil couldn't go any lower, boom, it did. It had a big drop in October, again in December, and now again in January. And really, it's all based on the Saudi-Iranian situation, where you would think that Middle East unrest would cause the oil price to go up, and it did for about 2 or 3 hours on Monday morning, but really what the street decided was that this meant that any possibility of the two collaborating to reduce oil output just went out the window, and it was going to be an all-out economic war to see who can get out as much oil as possible. And you know what happens when you got a glut? You get lower prices. So I think that's what the street really has ended up deciding here in the last couple of days.
If Iran and Saudi Arabia decided to start shooting it out, would that affect prices?
Oh, of course. Any war that is going to be on Saudi soil, oil's going to, from this price level, it'll probably double the next day.
And that still would leave you with, what, $70 oil?
$70 oil, yep. But you got to remember, $70 oil with a much, much higher U.S. dollar than it was before. Like the U.S. dollar is quite a bit higher now. So it's that would be a lot more expensive for other countries.
What about Canada's almost record low loonie now at its lowest point since 2003? Has that helped the Canadian oil patch at all?
Well, it's helped stave off bankruptcy. I don't know how much you could argue that it's helped. Oil's still $35, but you know, at $1.40, you know, that adds $12-13 to the price. That puts us pretty close to $50 Canadian, and a lot of our costs are down around $20 to $30 Canadian. So it definitely has helped for sure. Like I think particularly for the higher cost producers, it's just given them a lifeline and allowed them to stave off bankruptcy. But I do got to say, Jim, we are starting to see some pretty regular bankruptcies, almost one a week in Calgary. So.
And I was just seeing too that Swift Energy is the latest U.S. producer to seek bankruptcy protection. Now, is this a big deal?
Swift in itself is not a big deal. It's not a huge producer, but I think this is the thin edge of the wedge, getting a little bit wider. You know, we didn't see any bankruptcies really in the first half of this year, because we saw the oil price pick up and a little bit as a dead cat bounce, and that got everybody excited, and a lot of people were able to basically hedge out more production or raise equity. So it was a bit of a big deal here. So in that sense, I'm just being able to prolong the life of some of these companies. But now, really, the chicken's coming home to roost. It's like the money is just not there anymore, and anybody that had balance sheet problems is now going to wither and die. What it really means, Jim, is that for particularly the junior industry, when Canada's a big part of that, if these prices stay, there will be no junior industry. Like, you're going to need economies of scale to survive the low oil price, or some incredible assets, like just the best assets you could possibly have. Otherwise, like, there's no reason for anybody to be drilling right now, Jim. No reason at all.
Are the auction houses in Alberta busy selling off oil equipment?
Oh, I'm sure Ritchie Brothers has never been busier.
And what about Caterpillar?
Oh, they must be hurting right now for sure. They must really be. That they would sell all their equipment at the Ritchie Brothers auction house, so I'm quite sure that they're not doing very well, particularly in Western Canada.
UK North Sea production is up despite low prices. Why that?
Well, all the offshore production, Jim, that you see in the world, it has a much higher capex and a much longer lead time. So these decisions were all made to increase production in the North Sea like 2 or 3 years ago. So when oil was $100, $110 a barrel. So it take between the permitting and the construction time, like that's a 2 to 3 year lead time, potentially even more. So, you know, it wouldn't surprise me that a lot of these offshore plays, of course, the North Sea is very famous because that's where Brent is priced out of. Even for another year, we could see production pick up because once you've spent $1 billion, you're going to produce that asset, whether oil's at $20 or $200.
And of course, Shell had spent $7 billion for drilling in the Arctic, and now they've canceled that. Obviously, even with their deep pockets, $7 billion is just too much.
Well, that was exploration, yeah.
Yeah. And of course, once you start producing, you have environmentalists probably protesting the arrival of every tanker, and or do they care about PR like that? They do run a lot.
Shell's very PR savvy. Oh my, absolutely, absolutely. They you just look at what they're doing in Western Canada. They just got, literally just this week, they got the most advanced LNG permit, liquid natural gas permit, that's been awarded yet. And so they've been very much just in the background as kind of the number 2 player behind Petronas, being very quiet, cultivating all the right First Nations relationships and community support. So, oh no, they're a very savvy group when it comes to PR.
Yes, and I've noticed that for the pipeline industry, they show fewer ads on TV supporting it, but they still show them. So obviously, at some point, they would like to see those pipelines built.
Yes, I think now they're putting those ads out, Jim, just to keep their face in front of people. I don't think anybody in the industry has any real hopes of seeing something like either Keystone or Gateway get completed in the next few years. But yeah, don't get me started on the industry and their advertising. Oh my God.
Well, why not, Keith?
Again, Jim, the leadership in the industry has just been so dense at staying ahead of the social issues and not really wanting to engage the real questions of the environmentalists, not embracing any of the protests, and just coming back and saying, well, we create high-paying jobs, It's like, guys, they don't care about that. I know they should, but they don't. But you're going to lose. And really, we've already seen that. The industry has lost. The industry has lost big time. You're now seeing a massive rise in renewables, even though you could argue that in most cases renewables don't make economic sense yet, Jim. The public is on them, and there's just no way that either government leaders or big corporates are going to be offside this renewable push. And that's going to be completely at the expense of oil and a little bit natural gas.
In other words, they're willing to pay higher prices for energy.
Absolutely, they are. They are. And so this is the same kind of mass social trend that you saw with drinking and driving, wearing seatbelts, kids getting the strap in school. All that stuff happened 30, 40 years ago and was accepted, and now you couldn't even think of doing any of that stuff anymore. Like, you'd be thrown in jail for any one of those ones. And it wouldn't surprise me that 25 years from now, if you don't have some kind of renewable power in your home, you're going to be a pariah. Like, that wouldn't surprise me at all.
Well, I think we discussed it a few weeks ago. Shell spending $200 million to buy up part of a wind farm in Europe.
Oh, and it's not just them. Google, Amazon, Walmart, all these big corporates are buying their own renewable power because these utilities, they're just like the oil and gas industry. Half of them are Luddites, and they don't get what's happening, and that their business model is changing, and if they're not willing to incorporate renewables, they have to think outside the box. And if they don't, all these new young entrepreneurs that are running big companies, they'll go right around them and basically cut them out.
Maybe put wind turbines on top of the oil derricks.
Jim, you might be onto something there.
Okay, let's have patent pending on that. We'll have more with Keith Schaefer right after the break.
Unbelievable harmonies, spectacular performance, the ultimate tribute to the Everly Brothers and Simon & Garfunkel. Bird Dog and the Vintage Electric Band, Saturday, January 9th at the Alex Goulden Hall. Buy online and save at ontourtickets.com. More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on The Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
Welcome back. We're speaking with Keith Schaefer. Keith, oil and gas inventories in the U.S., the oil storage is down substantially, and they have, I think, an extra 5 million in storage of gasoline. Does that make any difference to the prices that people are paying?
Oh yeah, for sure. But it's interesting. This week, I think the market kind of got fooled a bit. There was a big draw in inventories, 6.5 million barrels, but a bit of a draw at a bit of a build at Cushing, but the main storage hub. But the reality is, Jim, that just the flooding in the Midwest actually caused a lot of the barges that carry fuel to not be able to get through. So there was a backup. So I think this week was actually a bit of an anomaly. I don't think oil and gasoline are both off very strongly today, and I'm not 100% convinced it's warranted just because there was so much barge congestion, traffic, that didn't allow things to get through. So
now some people, you're saying, are still bullish on oil, predicting that maybe we'll see $50 a barrel in a few months. Yeah.
Raymond James, a larger mid-tier brokerage firm in the U.S., had a big conference call this week, basically calling for $60 oil as soon as June. And trust me, that is way, way, way outside of consensus. So basically what they're talking about is demand. They just figure demand is up big time. There's no spare capacity. And I think they're right. There is some spare capacity, but there might be 1 million barrels a day with the Saudis, and then maybe another 1 million here in North America between the U.S. and Canada right now. But that's about it. Everybody else is producing flat out. And Jim, we've seen some big demand increases with lower oil prices. Like we're using about 1.5 to 1.8 million barrels a day more in 2015 than 2014. Now, normally we only jump about 800,000 to 1.1 million. That's roughly what the increase in demand is annually around the globe. But it was a big jump, a much bigger jump last year because of the low oil price, and they're calling for about another 1.2 to 1.4 million barrel a day increase this year. So that basically takes out all the spare capacity in the world. And really what Raymond James is saying is that is going to start to have a big impact on the price sometime at the end of Q2 this year. So May, June. You would be hard-pressed to find anybody else talking even $55 this year to average. And they're talking, this thing is the oil price will be there at $60 by June. So very much out of consensus call, all based on no spare capacity, which I think is more correct than the market really wants to believe right now, and just demand, demand, demand.
Well, in the U.S., they've seen a record high sales for SUVs, which we know aren't exactly the plight gasoline users. Is that a factor in this, especially as we go into driving season in June? Yep.
Oh yeah, no, for sure. You're going to see quite a good increase in demand in U.S. driving this year. I think that only makes sense. And I guess the other thing is that we could say is that they figure Raymond James really believes that the U.S. is going to win this price war because between rig efficiencies, technology efficiencies, and lower costs and wages across the board in the energy sector, it used to cost the average North American producer about $20 to $24 to find a barrel of oil. And Pioneer, one of the big U.S. independents, they just came out yesterday or today and said, they're finding costs in the Permian Basin in Texas, which is a granddaddy oil play in all of North America. The Permian Basin in West Texas is the Saudi Arabia of North America. And they said that they've got 8 or 9 different productive zones they bring oil from up out of the ground there, and they say their finding and development costs are $10 to $12 a barrel. Well, basically, oil can be $25 to $30 and they're still making money.
Was that unexpected?
I'm sorry?
Was that unexpected that they could become so efficient?
Yes, I would say that a lot of people thought a year ago that the big gains in efficiencies had happened, and from here on in it was only going to be incremental. Instead, it's actually been quite large, like 15 to 20% a year.
Wow, pretty soon it'll cost nothing.
Well, once you've got your capital paid back, the break-even price for your remaining production is mighty low.
What if the U.S. Fed decides that it should hike interest rates at their schedule 4 times a year? How much would that affect oil producers who have a lot of money, invested in debt? Yeah,
it would definitely hurt. It'd be another really push over the edge for a lot of the debt-laden producers. So that would, and of course, when you get rid of the weak in a market, that only makes the strong stronger. So, if that happens, all these debt guys I think the guys that hold the debt, the banks and whatnot, would probably get a little bit more strict about when they get paid back, how they get paid back. So,
any bets in the office on this $50 to $60 a barrel oil in June?
Yeah, I just don't see that happening. Because what's happening, Jim, is that these companies are still able to raise money. Like Pioneer said, they're going to outspend cash flow by a huge amount this year, and they were still able to go out and raise $1.5 billion in a couple hours this morning. So it's there's no more economics in the patch, right? Like economics doesn't matter. It's all about, okay, there's lots of stupid money around. The Fed has increased money supply so much that really, like, this oil price war is really the Saudis against the Fed. It's not Saudis against U.S. producers. If the lenders just had some sense, and equity buyers had some sense of economics and refused to allow these companies to produce on these crazy low margins, or even at a loss, U.S. production would fall off a lot faster. But economics doesn't seem to matter right now.
What about the fallout for Saudi Arabia after that mass execution? How much of a role is that?
The fallout is obviously that their neighbors hate them, but that's okay. The neighbors always hated them, and i.e. Iran, and that the price of oil's dropped $2. So all this squabbling is definitely hurting everybody.
Is there any ray of bright light somewhere in the Canadian oil market?
Well, the dollar. Our loonie is pretty low, and that's saving. And as the lower oil goes, the lower our loonie goes. So the reality is that the oil price in Canadian dollars isn't going down that much.
Well, yeah, especially if you look at what they're charging at the pump in Vancouver.
Yes, Jim. We could talk about that all day long.
And we have. But also, too, in Vancouver, you have the highest gasoline price or taxes in Canada. That doesn't help the situation for the consumer either.
That's for sure.
Keith, thank you very much for chatting with us, and I hope the rest of the year is a good one.
Jim, God bless you. We'll chat in a couple of weeks.
My guest has been Keith Schaefer, editor and publisher of the Oil and Gas Investments Bulletin. His website, oilandgas-investments.com. You're listening to HowStreet.com radio. Find us on Twitter at TalkDigitalNet. Check out our YouTube channel, Talk Digital Network. Comments or questions for the show can be sent to info@HowStreet.com. I'm Jim Goddard.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.